Renovo Home Partners doing $653 million a year just folded. Now, they were even backed by BlackRock. I'm joined today with Josh Sparks, the CEO of Infinity Home Services, to talk about what this means for the roofing industry at large. This is a long interview, but I recommend you listen to everything Josh has to say. Listen, he's running one of the largest platforms in the roofing industry. He's doing it right. I can't wait. Now, let's jump into this interview. Josh, I'm really glad to have you here because first, you are the CEO of IHS, Infinity Home Services. Is the title CEO? I didn't screw anything up, did I?
That's right. I'm founder CEO. That's right.
Yeah, founder CEO of Infinity Home Services. One of the largest, if not, do you know where you rank in the realm of these?
Well, when it comes to residential roofing businesses, we're up there. We'll call it we're the top 5 for sure, maybe top 2. Mm-hmm.
It's there was an infographic that was created and distributed, I believe, by
my boy Tom Bash.
Yeah,
Mm-hmm.
I have it pulled up. That's why I'm looking off at my other monitor. And looking through that was really cool. Just seeing the portfolio, and I have it pulled up here. By the way, I'll put a link to this in the show notes in the description that shows in that I actually have a friend of mine who's a platform for a company. I know it's not listed here, but this is a pretty robust snapshot of the industry. In fact,
I'll tell you, Adam, it's very cool to look at. When you look at that on the timeline, it's even crazier. So 2020, 21, 22, we exited, or we partnered with Freeman Spogli and at the end of 22, and then 23 was like, bam, it was like just shot up like crazy. Yeah. So, the private equity world found roofing, and nothing really crazy has happened since then, right? Or are we talking about something today?
We sure are. So we're here to talk about Renovo Home Partners. They were ranked number 8 out of Qualified Remodeler's top 500 in 20. I'm making sure I get this right here. That was 2023. They were ranked number 8, and they did $653 million in sales. And November of this year, 2025, they ceased operations, and now there's some Chapter 7 bankruptcy. And for those, I know when we talk with Josh, we're going to be getting into some financial conversations. I'm going to make sure to just keep everything really simple. There's Chapter 11, which is when a company files for bankruptcy, but they say, hey, we got a chance of making it. We can restructure. Chapter 7 is there's no hope. We are folding. And they filed for Chapter 7. And I know Dimitri just did a video recently kind of sharing this news, and I wanted to fill in what it was I viewed to be a really deep conversation around why and what this might signal to the roofing industry. And Josh, I wanted to bring you in because you have a seat at the table, so to speak, where you're getting insights into financial research and resources that most of us would never even be able to get your eyeballs on. And you're seeing this from the inside, running one of the largest platforms in the industry. So what does this signal to the roofing industry at large? But before we get there, why do you think they went under?
I think pretty straightforward. Well, let me just, maybe I'll say this, Adam, before I get into the financial aspects of the business. I think it's important to note for a lot of people listening that, many of these individual brands and people who worked under the Renovo platform were not bad companies. Mm-hmm. These guys had solid reputations. They had strong teams. The failure wasn't because, customers stopped needing the products. It is ultimately the capital structure and probably the integration in which that business model failed. I mean, at heart, Renovo was a private equity backed home improvement company, right? Mm-hmm. Very quickly through acquisitions. So they rolled up a number of regional brands across, siding, roofing, windows, baths, kind of all under this Renovo umbrella. Good intention, just like a lot of these other folks you're seeing happen out there. Great intention, consolidate a fragmented industry, leverage scale, professionalize operations and relatively unsophisticated contractors. All this stuff at face value is not bad, but when the pace of that and the structure of that growth is not built on sound foundation, it becomes problematic. And by sound foundation, I mean, probably here high leverage. And so When you saddle a company with an excessive amount of debt and then interest rates go up and your cost of capital doubles, and then take that, and then your lead cost starts to increase as other contractors become more sophisticated, consumer demand starts to soften, you can no longer cover your debt obligation. And that's probably what we saw here. Many of these platforms, and many of the platforms that are still here right now growing, are built for one thing and one thing only, and that is growth at all costs. And they built them on a zero interest rate environment. And when you do that, when you do that and it changes, you're going to see who's swimming without life jackets.
Mm-hmm. When you mentioned this, when we were talking right before hitting record, you said, you may have done more homework than me because I'm busy running a company. And I love that. Just a side tangent, looking back, you and I met, I can't recall if it was 2 or 3 years ago. I was speaking at the Owens Corning Platinum Conference, and it was the very first conference you had ever gone to in your entire roofing career. And I wrote it down. You said there was a poster behind you that said, "Work hard in silence and let your success be the noise." And I love that. And your mission at IHS is and I'm going from memory, so you have to correct me, is to rid the world of unscrupulous contractors. Did I get it right?
Yeah, that was my mission that I created back in 2005 at Infinity. We have softened it slightly to save our communities from unscrupulous contractors. We don't want to put homeowners out when companies go out of business, but we want them to survive. Yeah.
Yeah. So you and I connected on kind of shared philosophy and shared mission. But I remember, we went out to lunch with some of the Owens Corning people, and you kept me at arm's length. You're like, another one of these guys, another one of these sales trainers or gurus or speakers. And it wasn't until after lunch we were sitting at the resort around the fire, really connecting, and have stayed in touch since then. And I really appreciate that a lot. And I it's great. I know that looking off at this infographic, I've got a handful of companies I've worked with over the years that are, part of the IHS portfolio, one of which I was actually just texting the other day. So it's really great to see you growing. And that's why I wanted to bring you in as someone on the inside. Because, and as I'm looking down, I have copious amounts of notes doing my homework on this before we got on here. But the Renovo Home Partners platform, when you talk through debt, they had $150 million in debt. And there's some financial language that I'd love your help kind of articulating in the simplest of ways, that their debt structure was secured overnight financing rates, SOFR, plus about 650 to 665 basis points. Dumbed down, that basically means that their debt was at 12%. Now, I don't know what the secured overnight financing rate was, which I should have looked this up prior to this. Back in late 2021, early 2022, when this fund originally came to life. But you're talking about $150 million in debt at 12% from a company that did $650 million in 24. And then in 25, even though my understanding they were projecting closer to $1 billion in sales, they dropped down to $550 million in sales. You're talking about $100 million net loss compared to what they were doing before. And in Q2 of 2025, they were showing $66 million in realized losses. So when you talk about being over leveraged, what I'm seeing through this, and by the way, in the bankruptcy that they just filed, Chapter 7, they listed $100,000 of assets, less than. I repeat, 100. I mean, Josh, most roofers' trucks are $100,000 assets.
Yeah.
This is less than $100,000 assets. And what's crazy is they're showing $100 to $5 million in $500 million in liabilities. Monumental. So what I have gathered, we had this immense roll up starting in 22, crazy acquisition, tailing off the ZIRP era, 0% interest growth on this variable liability financing that then turned massive with a unrealized growth trajectory as the market peeled back, which many people are feeling now, in an inability to service their debt, sprinkling in what I'll call confusion, operational confusion, where things didn't sync between the 19, I believe it was 19 different brands. and then a loss in leadership, where leaders were high level leaders, CEOs and founders were no longer part of operations. And it seemed to be the perfect storm.
Well, I think you did a fantastic job of right there, Adam, of just laying out what happens when exactly what you said, when you have a zero rate interest environment and you have a thesis and a strategy built on aggregating businesses, buying regional brands, using heavy bank debt or heavy leverage to do that, to the point where the current EBITDA often, or the current cash flow, can barely cover the debt service. So if you don't grow, you start going backwards immediately. You start pulling on a DDTL loan or some, a delayed draw term loan, and your interest rates keep going up and up and up. And you get to the point where you just don't have cash flow to service that debt for long periods of time. You bust your covenants with the bank, your leverage covenants with the bank, and then all hell breaks loose. And at that point in time, you either recapitalize the business, and so these partners have to go and put more cash back into the business. And anytime they're going to do that, they're not doing this thinking about their customers and their people. They're doing that based on the actuary tables that go, if I put cash in, do I think I can save this? And there's a point in time where they say, this cash is just going to get burnt up. This business is not savable. We're cutting ties. And that seems to be what happened here.
Yeah. So with your view of how the roofing industry is, the trajectory of the roofing industry, does this send signals? Because I know people have seen this news and I'm hearing this semblance of panic. Is this a sign or a signal to the roofing industry or not? I'm curious on your opinion here.
Without sounding hyperbolic, yes, it is a major signal. So let me just take a step back. So there's nothing fundamentally wrong with private equity and how they do business. Private equity adds a lot of value to industries. It's proven. So there's not an issue with private equity. The problem is how some firms operate and how they enter the market. A lot of folks say a lot. Let's just say some PE firms focus heavily on financial engineering instead of operational excellence. So you can't spreadsheet your way to great craftsmanship, great customer experience, and good culture. And when I say financial engineering, let me just maybe kind of clarify what some of that means. We all know there's 50,000 active roofing contractors. We all know there's some good companies who deliver good products and services to the homeowners through good culture. And we all know that there's some who don't. Well, a financial engineer could go in and say, we're going to take this asset where they don't do those things, but they're making $1 million a year. We're going to try to buy them for 5 times and then add 5 more of those folks and then sell them right away and flip them for 10 times or 12 times or whatever the number is and make this multiple arbitrage. Everybody learn what multiple arbitrage what it means. And they're like, well, I can go buy 5 separate companies, not integrate them, not do anything with them, and then make a bunch of millions of dollars. Well, yeah, you might be able to get away with that, but more often than not, you're not going to. And so that's a piece of financial engineering. Another way to financial engineer a company is to take a small town business that, let's say, has been around for 20 or 30 years. That's maybe a lower margin company, 30% margin company or something, and then buy them, raise the prices by 20 or 25%. So you immediately start lifting profitability and EBITDA. But being in a market where that's not sustainable long-term, they're going to do that, watch that company rise, and then they're going to try to sell it. But you create sentiment in that small community where, hey, these are another high-priced contractors, and you're not building a durable business long-term. And so that is another way to create financial engineering. So is this a concern? I think this is a reset. I think people should be looking at this and going, how do we separate the operators from the financial engineers? The ones who actually know how to run a roofing business will endure, and those who are just stacking acquisitions for multiple arbitrage are going to struggle. And so that's the bottom line.
Yeah. It's interesting hearing your perspective on this, because ultimately what I hear through all this is that this isn't a signal about the roofing industry. It's a signal about a very loud and aggressive strategy within one ecosystem of roofing, which is PE. And my understanding, and you please fact check me if this isn't accurate, but currently the market share of all the largest platforms on this sheet that Thomas put together still only makes up about 6% of market share.
I thought that might even be high. It's about a $90 billion TAM right now, just roofing alone. Add siding and windows, you're probably over 200 billion in TAM.
Yeah.
Out of
Which,
the numbers on these companies, you might be, I didn't add them up, you might have, but
yeah. By
it's
the way,
small.
TAM stands for total addressable market.
Yep.
So yeah, my point is, even at 6%, which is the number I saw, you're like, that could be high over the next 3 years. And I've seen statistics, by the way, which I have to really examine the source to see the legitimacy of these. But there are rumblings that the pace of acquisitions in the roofing industry is that there's a deal being done every 48 hours. That to me sounded a little aggressive. I wasn't quite sure about that. But either way, there's with the trajectory we're on and the larger platforms taking, you're like, yeah, 6% might be generous. From my research, and I share this in the 2025 to 2028 roofing market report, there's a link in the description, Josh. That's what I sent you right before this. What I'm seeing is in the next 3 years, it'll make up about 10%. Like, but with the Pac-Man strategy, the biggest players will make up about 10% of market share.
Mm-hmm.
Now,
I think it's important.
Go ahead.
Yeah, I mean, I think it's important to understand is, the difference between a private equity backed or an investor backed company versus a sole proprietor or just kind of a single owner. If I'm building a company and I got to buy trucks, I got to spend money on marketing, and I build a $10 million business, let's just say, and I make $2 million bucks, and I'm 20% margin business. I'm feeling great. The next year I do 10 million, but the market's tougher. I got a bunch of mom and pops that are fighting me on pricing. So I lower my pricing and I make $1 million bucks instead of 2 million. Well, most entrepreneurs, they don't care. It's fine. They're going to keep paying their people. They're going to pay their bonuses. Their people are working hard. They're going to support their community. But when you buy that business, you have investors. Now you have debt obligation. And now you're like, hey, I need to make that 2 million. If I don't make that 2 million, now I can't pay my creditors. And if you put too much leverage on the business when you do that. And so it's just it's a fundamentally different way that the businesses need to be managed. And so then what they often do is they go, wow, I can't make that 2 million. My volume's down. We'll raise prices. Oh, and then your volume goes down more. Oh, cut costs, cut people. And now you lose people. Before you know it, you have an asset that's just falling apart. When roofs in that community still need to be replaced, they still had a great reputation, and you take the business because you've over leveraged it.
Yeah. So in this realm of the consolidation or private equity activity in roofing, it's a different game than a mom and pop owned operation, because a mom and pop owned operation can weather the storm through highs and lows. If you're making $1 million a year or $2 million a year, your lifestyle really doesn't change. I mean, I shouldn't say that for everybody. Someone who's competent at managing their money, your lifestyle doesn't change, right? I know that there are people that their spending budget. I was just out to dinner with someone, actually, this mastermind group I'm part of, and they're like, I need at least $500,000 a year for my place spending. And, and then you have other people that are like, that exceeds everything I could ever live on or need to live on. So my point is $1 to $2 million a year. If you're a savvy entrepreneur, nothing changes. But when you have a debt load to service or a bigger strategy, money to pay back, that game isn't okay. So There's pressure. And what I'd love to shift this conversation to, Josh, is how you see the pressure being applied, because it's no secret that the roofing industry is feeling pressure. We have interest rates that we still are like unaccustomed to, even though I don't believe they're going to be changing a whole lot. I know the Fed said they're going to make another cut here in December, but we are seeing interest rates that are no longer the pre-COVID COVID era, 0% days. We are seeing ARMA data showing a significant reduction from about 172 million squares to 140 million, essentially pre-COVID levels, pre-boom levels. And we're feeling shifts from, I know finance providers are not writing loans for homeowners with credit scores. Now I've heard some, it's like the floor has been raised to even 700, and we're seeing material prices continue to increase. And there's all these changes. So everyone's feeling pressure. Talk to me about the difference in pressure between an independently owned owner operator versus a platform experiencing like what you're experiencing as pressure right now.
Yeah, it's a great question. Well, first I'll just say that we are facing some headwinds in this industry. There's no doubt about it. But it's funny. I've talked to some folks who are in economics and look at the markets, and they always tell me, I predicted 9 out of the last 2 recessions. And so everybody is thinking that we're going to continue to go into these recessions and like we can see how these problems and headwinds. Listen, we are in a wonderful business, Adam, right? This is a non-discretionary business. Nobody wakes up over a cup of coffee and, to their wife is like, boy, I can't wait to buy a brand new roof. People put roofs on because they leak, because they have to, they reach the end of their serviceable life, or their insurance company says that we're not going to reinsure your home unless you put a new roof on it. So we are millions. I think the latest report I looked at was something like 3.5 million homes underbuilt. So we're still building houses. These roofs are still going to age. Roofing is going nowhere. And so when it comes to the pressure of going out and finding more work, it really depends. You mentioned earlier, so mom and pop versus a private equity backed company, both of which generally, as far as I know, are pursuing growth. They both want to go out there and win. They want to get more customers. They want to build the way you develop your talent inside your organization and allow people upward mobility as you grow. You continue to grow as an organization. The financially backed companies have more pressure to grow from time to time, especially if they're over leveraged.
Mm-hmm.
And I'm not saying that all PE firms do that. In fact, most of them, I would hope, ours is certainly conservative. They have tons of capital. They make an investment. They do take on debt, but it's a strong balance, and they have the ability to recapitalize the business if we face an extended period of headwinds. But to your point earlier about your buddy you talked to in the mastermind group, if he needs to make $500,000 a year, or she needs to make $500,000 a year, she's also at all costs going, I need to grow this business to make my money. So I think people put that pressure on themselves, is what I would say. And each PE firm has its own thesis, its own expectation of growth, and they try to hit those.
Yeah, it's true. And when you mentioned we're in a non-discretionary industry, the U.S. housing stock, I believe 45 U.S. housing stock is 45 years old. That's on average. And the 2000s had this big housing boom. Well, we're in the year 2025. Who's going to need roofs? Right. So the market is shifting, and it's interesting. I talked to some distributors, and they're like, yeah, I know this is like not ideal, but we're going to weather this storm. The industry is not going to collapse. And I'm grateful to be having this conversation to bring some relief, because I see a lot of panic in the industry right now. A lot of panic. What's happening? And I'm going to give a terrible example, but I'm going to give it anyway. I live in Colorado. Marijuana got legalized in Colorado. There was a dispensary on every single corner. And it reached a point where there were so many options for this new shiny thing that those dispensaries began to go out of business, even though it was a cash cow. Everyone was moving into this marijuana industry. And I see the exact same thing that's happened in roofing. We had all of these companies. It's always been competitive, but you had the 0% interest rates in the COVID boom. And then you have how many there are, and Josh, these companies, the big names in the markets. And then you look at everyone else, and they're all spinoffs of that big name. Everybody worked for so-and-so and then left and said, I can do this either better or I can make more money. So now you take a market that's spun off 5, 10, 15 competitors, which is not exaggerating. I have 2 markets that I literally know nearly 10 companies that have spun off from. And then you have this bubble that is now burst, and companies that were younger companies, and I'll just say in business maturity, maybe not preserving cash flow to say, hey, I need to have enough money in the bank to overwinter, or I have to, my lifestyle adjusted a little too comfortably while I was making money. And I predict, and I'm curious, I haven't shared this with you. I predict that over the next 3 years, 30% of roofing companies are going to go out of business.
That's interesting prediction. I can just tell you from my experience, Adam, I started my business in 97 at 18 years old. And I remember handing out flyers and selling jobs. And even when I was 19 years old, I'd go do an estimate for a roof, and that customer was getting 3 other estimates. Now, whether they would show up or not, I mean, oftentimes, especially in the early 2000s or late 2000s, people wouldn't show up. But we've had competition in roofing forever. There's been thousands and thousands and thousands of roofing contractors. And so I don't think competition is changing. In fact, I think with private equity in the space, they're trying to drive margins up. And so you're seeing these folks spend more money in marketing. From time to time, I get people come to me and say, I've been in business for 40 years and I have to sell to private equity or I'm going to get crushed. And I said, what the fuck are you talking? I don't know if you mind if I cuss on this podcast.
You can be you.
Yeah. What the fuck are you talking about? You know, like no private equity company, no big conglomerate, no Home Depot is going to put you out of business if you take care of your customers. Full stop. Full stop. Like if you're running a successful $7-8 million roofing company and you're making money and you're taking care of your family and you get to go golfing on Fridays and you want to keep doing that, nobody's going to stop you from doing that. I would say the only difference between the professionalism now of the industry and the fact that there's investment in the industry is it's going to be much more difficult to scale your business, is what I would say. So what I did, I grew my business from 0 to 40 million into 2019. That will be more difficult because I was pretty unsophisticated when it came to marketing, when it came to sales, but I was able to just continue to deliver that experience. It will be harder to get those incremental leads now because you're going to face more competition around the marketing side where you have more sophisticated players. But as far as small folks, they're going nowhere.
Yeah. So with all of this, there's really nothing to be concerned about other than put your head down. Business is business. It is constantly evolving and changing. We're in a cycle of continual change. And that's the only thing that's changing about change is the speed in which things are changing.
I would say that, well, let me just say this. I wouldn't say put your head down and keep working. If you plan on not selling to private equity or not having a liquidity event for yourself, keep your head down, keep working. Don't worry about all the noise that's happening out there. Service your customers well, become a better operator every day. All the stuff that you're teaching your group to do, Adam, which by the way, I love exactly what you're doing. You're bringing integrity and quality and the right things to the business that this business really needs. But if you're considering selling your business to private equity, you need to be very careful about that because you don't get to look at the balance sheet of that investment platform. You don't know if they're highly levered or if they're not, because they're oftentimes not going to tell you that. And the last thing you want to do, like, it was heartbreaking for me, frankly. And I had this mission to rid the world of unscrupulous contractors, but frankly, it was heartbreaking when I read some of the stories about Renovo and how his dad started the business 42 years ago. And now, promise your employees this and everybody's out of a job. Like that would break my heart if that happened to my company. Yeah. So I would say you just need to be more careful.
Yeah. Speaking of that, the human side of this, I know we're sitting here having this conversation. It might seem callous, especially if an employee was tuning in. It's like, that was my livelihood. I believe it was 2,500 employees that were laid off. Qualified Remodeler, I believe, in fact, I might even have it still up on my computer right here. Yeah, it was Qualified Remodeler, and they even shared a screenshot of the, and you know what, I'll even put it up on the screen right here. They shared this. It says, and this was just an email that was sent to Reborn Cabinets. It says it was a relatively stale email. Imagine getting this when your entire livelihood's banked on it. That the subject says Reborn Cabinets termination of employment. That's in your inbox. Like, what? That's the subject line. And then it says, dear team member, not even personalized. Dear team member. Okay, we regret to inform you that Reborn Cabinets has made the very difficult decision to immediately cease business operations, resulting in the termination of your employment. Effective as of today, October 29th, which is the separation date, the legalese coming in here. The company intends to pay all final wages earned through the separation date, blah, blah, blah. And then the rest is we want to thank you for your service as an employee, and we wish you good luck in your future endeavors. And it's like
a big middle finger to me.
It is. And, I'm all, when I started doing my homework, and I have some of these notes up here because I spent hours getting ready for this interview, there was, let's see if I can pull up to the part I wanted to share. There was no WARN Act notices filed. So apparently, and I have to look into this a little bit more, it was an immediate termination without notice, no WARN Act, which I guess there's some legal notices for mass layoffs that weren't abided by. Health insurance was canceled within 3 days, which, people didn't even have time to get Cobra or something else. So anyway, there's apparently legal investigations underway for WARN Act violations.
Yeah, that's the thing that's sad. It didn't, the collapse didn't just infect investors. It left homeowners with unfinished jobs, deposits that people have right now for projects in limbo. employees, like you had mentioned, without warning, no paychecks, and who knows when those final paychecks are going to come. That's the real tragedy, and the ripple effect on families and customers and the community writ large, I think is sad.
Yeah. And at least I'm seeing it. And it might be like when you buy a white truck, everyone has a white truck, but I am seeing more and more news stories of homeowners that have given deposit to a roofing company that goes bankrupt or is insolvent. And then now that deposit, you don't get that back. And that happened to us when I was a contractor. We had a $70,000 deposit for windows for a commercial property. They were damaged in a tornado. And we went to go pick them up in the spring. And the guy goes, "My assets were seized by the IRS. I don't have your 70 grand. I was like, "But it was 70 grand. He's like, "Well, good luck." Now the IRS, we're not going to be like, "Hey," and he made light of it. He goes, "It looks like I wrote off one too many cheeseburgers." I'm like, "Dude, this is a $70,000 check."
Yeah.
But again, we had no recourse. We lost $70,000. And at least we were a business that could recover from that. But a homeowner who hands over tens of thousands of dollars in deposits, they don't. So, what would be your like, if you could give advice to the roofing industry at large, to every single roofing company owner, to help them be prepared and successful over the next 36 months, what would it be?
That is, be a better leader, right? Run a better company, service your customer better. Look, I would say this, I think actually right here, the behind me, the 4 virtues of Stoic philosophy, wisdom, the Stoics believed that wisdom was the ability to see the world clearly, without ego, without distortion, without wish thinking. To me, that clarity point of that virtue is what really you should have an understanding of in your business. You should know exactly why you're winning and exactly why you're not winning. You should know I listened to a talk the other day, and I think it was the vice chair of a great day. And he talked about breakfast with the numbers. Every single morning that I woke up, this is true, I was in my CRM. I looked at everything from lead conversion to SAT appointments, to demos, to closing, to job profitability. I looked operational efficiency, leverage. I looked at every piece of my business every single day. So really, you should know your company. I think the worst advice that has ever come out, I've heard it from gurus talk all the time. Don't work on your business, or don't work in your business, work on your business. And I think that was the worst advice you could give any one of these entrepreneurs, because what they do is they close their eyes. They say, "Hey, is everybody doing their job? Great. Is everybody doing their job? Great." And then finds out, 6 months later, nobody's doing their job, and you're out of business. So really, you need to understand how your business works. And it seems very simple, but it's true. Know your business, know your metrics, know why you're winning, know what you need to do to continue to win. And like I said, if you do that on a day-to-day basis, and you don't partner with a private equity company that over-levers their assets, then you are going to be just fine, and you're going to win. You know why? Because there's a lot of people who won't wake up and do that. They don't have the discipline. They just don't have they don't have the courage. They're not going to do that. And so if you're willing to put in the hard work, and you're willing to be disciplined with how you operate your business, and you have the clarity and wisdom to be able to see what matters and what drives your business forward, nobody can stop you from being successful. They just can't. So that would be my advice. No matter like as a CEO of a $500 million company or the CEO of a $5 million company, it's the exact same thing. I wake up every morning like I did when my company was 5 million, and look at the numbers and understand my business. That's what matters.
Yeah. Josh, thanks for joining me. And if you want to piggyback on Josh's advice of not working on your business, but rather in it, jump into this very next video, because Josh and I share that philosophy. And I did an entire video about that to help you be a better leader.